oversubscribed, so I'm really excited. And we are really delighted at Unleash that our talks are really bringing, the learning, the development, and the inspiration, exactly what being in the Unleashed community is all about. So please note that we are recording the session, and this recording will be available on our website in about a week or so, or even earlier. And if you have got questions, please feel free to ask the questions in the chat box. Before I start, I would like to say that I'm very excited about our class of 2022. And, Unleashed runs an accelerator program every year. And I would like to congratulate our 6 startups, our 6 incredible startups that have made it to the Unleashed Accelerator this year. Enifer Bio from Finland, Farragon from Austria, Kibis and Moa Food Tech from Spain, Knock from Portugal, and Vetwork from Egypt. So we've been really, really excited. We've just had our onboarding. We will actually be accelerating these startups for 6 months from May to October. And we'll be rolling up our sleeves and with the startups and the Purina teams, the whole team's about 43 team members to drive learnings and to drive growth. So congratulations again to these 6 startups. Another announcement before we start, a date to note, 12th of May in Barcelona. So that's next week. Unleashed will be at the EU Startups Summit. It is not often that pet tech takes almost the central stage at a startup festival, but Unleashed is making it happen. So we want investors to take notice of us. So please come if you happen to be in Barcelona on the 12th of May, come and hang with us. We have on the workshop stage a couple of speeches. We will have another pet tech investor panel. We'll talk about different things. And then we have a pet tech startup pitch. You see the 8 startups that will be pitching during this time. So it's going to be an exciting day. I'm looking forward to that. So with this, I think it can bring us to the panel. So what I would like you to do is to mute your microphones if you can. And we want to focus on the speakers, the panelists, and turn off your videos. We want to see the panelists. So if you don't mind, please mute your mics and switch off your cameras. So I want to welcome Katie from JamJar, Louis from 5 Seasons, and Dominique from CapMartins. Thank you very much for being with us. Really excited to have you. And they're all great supporters of pet tech, and they genuinely would like to see this sector become very successful and big, and that we have a very, very good pet tech ecosystem. So they will do a much better job. So the ones who have just come in, please turn off your cameras and let us focus on the speakers, if you don't mind. So they will do a much better job of introducing themselves than I would. So I'm going to pass it over to each panelist to briefly introduce themselves. Let us know what their investment thesis is, and maybe talk about the pet tech investments that they have made. So we get a little bit of a foundation. So Kathy, can I start with you?
Sure. Hi, I'm Katie. Nice to meet you all virtually. I'm partner at JamJar. We invest in consumer brands, mostly digital, but we also do totally offline brands. We love pets as a space. It's a space we're really excited by. Historically, we've backed Many Pets, which is just rebranded from Bought by Many, which is pet insurance. And we backed Tails.com, which is personalized dog food. And we've seen many more, a few of which we should have also backed, including a few that 5 Seasons have done, Louis. So it's a space we're really excited by, and yeah, we'd love to do more in it.
Fabulous. Louis, maybe it would be good for you to take the stage now.
Yeah, sure. Hi, guys. Good afternoon. So I'm Louis. I'm an investor at Faison Ventures. So for the record, Faison Ventures is a pan-European VC fund based in Paris. So we invest in food tech startups mainly with an impact angle at Series A or B stage. We typically invest tickets between 2 and 10 million for first investments, and we can invest up to 20 million per company. So our portfolio includes a couple of rock stars. So I can name, for example, La Fourche, Pixo, YFood, and Arab, but also just spices that we recently sold to Kraft Heinz, the large food corporates. Regarding our investments in the pet tech and pet food space, so we have made 3 investments in this space so far. So the first one is Butcher Box. It's a British company offering fresh dog foods with an online subscription model. So they have done like amazing in the past years and have raised like several successful rounds of funding. So the second investment is Barkin, which is a Portuguese startup operating also in Spain and in Italy and offering personalized pet food combined with a televet service via chat, video, or voice. Pretty powerful tech company, I'd say, with a strong tech angle, doing great too. And the last one is Mamali, which is a German company offering functional snacks for dogs to, for example, so that the dogs have strong bones, healthy teeth for good digestion. So, and this is our latest investment in this space. So yeah, very happy to be part of this panel and to share some insight maybe about the space.
Fabulous. Thanks, Louis. And Dominic, last but not least, obviously.
Thank you very much, Kim, for having me. Thanks, Louise and Katy, for sharing the panel with me. I'm Dominic. I'm Swiss. I'm a foodie since birth. That's already now 53 years ago. I'm an e-grocer. I'm selling food online for the last 25 years, starting 98. And today, that's my expertise, where I act as angel investor all along the food value chain. I combine retail, FMCG, and digitalization. That's what I'm doing. Seed, early stage, so very, very early focus, Europe and also Middle East, and basically into startups where I can add value, where with my 25 e-grocer food retail FMCG expertise, I can bring value. That's me basically. I'm not yet having an investment in the pet tech sector, not yet. Indirectly, I'm involved as a Nestle Purina New Business Council member, of course, but I'm invested in direct-to-consumer models like Jiffy, Farmy, Trill, Reckon, etc. But always very, very early, the risky stuff. Before I hand over to Luis and Katy to scale.
Yes, I think that's this whole network, which is really important. And I know that we are slightly food tech heavy here. I'm sure that, we'll go into the digital tech as well. There are many of us here who are in healthcare for pets, not just food. There are people who are doing, digital solutions like collars and tracking devices and so on and so forth. So, I think it'd be quite nice to hear about your thoughts on that as well. But coming back to it, just kind of interesting to understand from you, what's a normal day in your life? How many pitch decks do you read in a day, in a week, or a month? So, and maybe that will give us an idea as to how busy you are, right? When we come to you with something. Katy?
So we look at about 200 decks a month. That gives you an idea. We don't meet all of those necessarily, but that gives you an idea. And we do about 10 deals a year.
Okay, that's really interesting. And Louis, what about you?
I'd say it's quite similar. I would say 100 and up to 200 per month. But what's very time consuming is also like digging deeper, but also meeting the entrepreneurs and building amazing relationships with them. So I would say it's not about the volume of decks that we read, because it's pretty much a streamlined process, but more about the execution of the deals and getting to know the entrepreneurs, because at the end of the day, I like to say this, but it's like a marriage. So you have to make sure that you marry the right person.
Okay, marriage. Good. And Dominic, how do we actually get to you? Do you read the decks? Do you meet people? How many decks do you read?
There's a difference between receiving and reading. Maybe I receive between, I don't know, 10 and 20 a week, and I read maybe one third to half of them. Half of them do not even cross the filter of being readable at all or interesting. And investments, I have done so far 12 investments in the last 1.5, 2 years. So that gives you roughly an idea of the filter.
So it looks as though we really need to stand out for you to even want to read our decks or want to meet us, right? Since you are actually looking at so many startups and so many of them are coming to you. What about these cold calls? I mean, I often myself receive things on LinkedIn. I don't know the person. I get a lot of messages. I even get a deck, right? A full deck, 50 pages, 20 pages, whatever it is. How do you feel about these cold calls? Katie?
I like cold calls. It's just I don't prioritize them as much as I prioritize warm calls. So I don't have a problem with them at all. They're useful. And, you know, we've had the debate internally a few times, should we even have a kind of generic email address? And the answer is always yes, we should, because we should be accessible. You know, there needs to be a way if there's no other way of contacting us. But the reality is you'll always get prioritized if you can come through a warm introduction, which is best, so a trusted introduction, or if you're able to meet someone on the team face to face, that also can be great. But it's a bit of a chicken and egg. The route I often see works best is use the contacts you've already got to try and get an introduction. If you don't have those contacts already, then, you know, like, for example, they could go through you, Kim. But if you don't have those contacts already, then you can build them. But I would take the approach of kind of making contacts that aren't VC to help you get into VC. Or like, you know, so for example, meeting angels might be easier than meeting someone already in venture capital, and then those angels can connect you to someone within venture capital. So if you're in it for the long game, you can plan ahead and make sure that you build your network as you go so that you can get warmer introductions, which can help you. But I'm open to cold stuff as well. It's just I put less time into it.
And what about you, Dominic? Like it hot, cold, warm?
I like the surprise factor. I like actually cold calls. Sometimes it even happens that my phone rings. I don't even know where they got my mobile phone from. But then it's really like, is it a kind of copy paste approach? Do you realize that in the same mail, 20 others have received? Or did they really try to reach out to you? Do they know what they want? Do they know me? Do they know what I can bring them? Because sometimes you get really things that, what are you talking about? I received yesterday one guy that wanted me to finance his movie he's doing in Colombia with animals. I said, come on. I mean, that's really not my thing. I was actually reading the deck because I thought it was funny. So cold calls, I like them when they're nicely tailored. It's a little bit like looking at a CV. I mean, do you like it? Do they call you Dominic? Nicely spelled, or is there already a typo at the beginning? Warm calls as well. It's a network with other investors you have that they say, listen, I have this case, I like it, but it's too small for me. What do you think? Or Dominic, that's your expertise. Can you dive into it? And sometimes I came across really nice opportunities like that. Or I get a case, I like it, but it's too big for me, so I pass it on.
Mm-hmm. Mm-hmm.
I think quite a good way of thinking about it is like dating. So it's kind of, do you want to go on a blind date, or do you want your friend to introduce you to someone that she thinks could suit you? It's that kind of approach that you're going to take to meeting the person. The blind date, you're a bit more nervous. You're probably more likely to go on the other date first. It's not that you're not open to it, but there's that bit less context and that bit less understanding or recommendation before you've met them.
And Louis, what about it? Do you like blind dates? Or would you rather have an introduction?
I'm actually taken, but I think that Dominique and Katie made a very good summary. The key point here is about standing out, and I think, like, for me, there are two ways to do it. The first thing is by being unique. So like you need to catch the attention of your audience. So find the right hook. So basically like we at 5 Seasons are very data driven and we're very number driven. We like direct to consumer food brands. So if in like the very two first sentences, I see the numbers and I see that in terms of focus and what you do, you're clearly in our sweet spots. Of course, I'm going to take the call and I'm going to be proactive and reaching out like very soon. The second pillar is what Katie described. It's about like the warm intros. We have our network, and like the entrepreneurs can reach out to some of our advisors or to some funds that could be friends funds. For example, JamJar, we've worked with them in the past and we looked at companies, similar companies. So if those guys tell us, well, there is this company that's not for us for XYZ reason, but that could be for you because there is this interesting angle and you should look at it. Maybe it's more software and you know that you like software. So yeah, I think those are two good ways to stand out and to be efficient in your way of speaking to these investors.
Maybe if I can add something, sometimes the way these entrepreneurs are acting with us investors show a little bit also how they're acting with other partners and stakeholders. So do they instantly give up if you just do not give a reply within 1 week, or do they come back to you? So they're a bit pushy, they're proactive. They said, hey, have you read it? In the meantime, this and this happened. Really, it shows a bit of how persistent they are, how pushy they are, or it shows also a lot of them.
Yeah, and I think, now we're talking about, entrepreneurs coming to you and trying to get attention from you. I understand that you guys are also very proactive, right? And that's the other approach that you've got. So how do you actually do this proactiveness? How do you find the startups that you are interested to invest in? Louis?
I think the keyword here is network. You have to build your own network. It can be a network of entrepreneurs, so meaning especially your portfolio companies. So for example, the founders of Just Spices or Pixo, they recommend other entrepreneurs and they can make intro. So this is the first thing. And the second thing is also the other VC investors. So you have to monitor the odd deals, you have to monitor the odd entrepreneurs and be in touch with them. So yeah, I think network is key. So yeah, and maybe another way is also like the online tools. So if you think of Crunchbase, D-Room, all those tools can be good, like to find companies and to track them, and also to put reminders. So you have them in your radar screen.
Okay, now that's useful. Any adds to that, Dominique, Katie, about this, your proactiveness, your approach to startups? How do you find your startups?
Well, network is definitely one thing, but the other thing is that you mingle at, I don't know, industry gatherings, that you're curious, that you participate in events. It's not only entrepreneurs approaching you, it's also you approaching entrepreneurs, especially in a very early stage. Sometimes I teach at university, I give some lessons, and there you bump into these guys that have a crazy idea. And then you start talking to them. So it's really, you have to be curious, you have to be open. You have to give people a chance, and sometimes you have really to try to understand what they're doing, because sometimes it's not easy. But just being curious, be open, give people a chance, and network, as you said, Louise.
Yeah, the only thing I'd add is, I think with food stuff particularly and beauty stuff, you can see it in store. In early stage retail, a lot of the time, physical product will try and get some physical space, and that can be interesting. And also advertising, like being open to being advertised too, whether it's on TikTok, Facebook, Google, whatever it is, Instagram. There's a lot of interesting brands that are trying to reach their consumers, and so we're consumers too.
Good. So I suppose a note for the startups who are out there: join the Unleashed Startup community and network with us. that would be a very good thing to do. So let's go into the nuts and bolts of this talk, the metrics that we're talking about. And of course, Louis, I think you mentioned about numbers, that catches your attention. And, and you mentioned to us that you do kind of a little bit later investment. So I guess there are numbers there when it is a Series A or B sort of deal that you're looking at. But basically, I think, a lot of us here are early startups. And so what do you look for in an early startup? What are the key metrics that you look for in a pitch or in a conversation with these startups? Dominic, would you like to start?
Yeah, with pleasure, Kim. Well, I do invest very early in companies, so sometimes there's really not a ton of data around, not yet. And they're just being established here, I don't know, in the idea or point or in prototype or MVP phase. So I look, what's the idea? Is it unique? It's not the data, but it just tells you something. Do I like it? Is it something special? Do they really solve a problem? Yes or no? And then I look at the market. What is the total addressable market? And can this market be serviced? Yes or no? Is it worth it? What is the battlefield out there? That's something I'm looking at the beginning. And then when they have done already some sales, yes, the primary metric is, yes, is there a kind of, I don't know, are there sales? Are there orders? Something, is there a kind of a customer traction? So whatever product or service it is, do actually customers are willing to pay for it? Does it help? So that's at the beginning. And then afterwards, you come into the secondary metrics. It's more, do we have customer traction? Is there repeat purchases? What is the kind of customer lifetime value? What are customer acquisition costs, margin, net promoter score, etc.? But that's later.
And Kathy, you do quite early stages as well, and I see that JamJar has also done digital investments, right? You've done an investment in apps, and that's really interesting, a little bit different from food tech, I would say. What are you looking for?
I mean, for us, it starts with people, which isn't obviously a metric, but we're looking at the teams and the team's skills, how the team's background, the team's suitability for the space. We're looking at the market opportunity. It depends where the company's up to. We're early stage investors, so that can range from, idea stage to post-launch in reality. The more traction you have, the better. I'd always say that, in the sense of, if you can demonstrate huge traction, that's always going to be more attractive than someone that's got no traction. But it's not always possible. Some businesses, they do genuinely require a lot of money to even get started. So in that instance, we look at what's there. So if there's a product there, we look at that. We always look at product if there is one, which, funnily enough, a lot of people don't. And we have a view as a team on products. Sometimes we do market research. We'll contextualize the product, relative to what else is out there. If there is traction, then, as Dominic said, I think revenue is key, number of users, and then you've got the secondary metrics, probably most important of which is cost per acquisition, often called CPA. So how much is it costing you to acquire somebody, and what's their lifetime value? So what's the gross margin over time that you'll get from your users, which is linked to what their repeat rate is. So how kind of cohorts of users behave. So if people first bought your product in March, how do they behave over the next 12 months? How often do they repurchase, etc.? How long does it take to make back the cost of the good for you as a business? So there's all kinds of things you can look at. It's interesting because I was talking to a friend this morning, and she was saying that she's having a really tough time because she's at 40k a month revenue, and she is being told by all sorts of investors that she's too early, and she's finding it really frustrating because they're all early stage investors. And she said that she feels like she'd probably be getting more traction from investors if she was pre-launch. And I do think there's something in that, and it's worth saying because it's kind of contradictory to what we're saying, which is, it's better to see loads of traction. If in some instances, it is worth being aware of whether it's better for you to raise money before launch or after launch, because once you have launched, if you haven't blown the lights out, often investors are going to always be asking for more data. So I think it's worth being strategic with when you do what. On the other hand, if you haven't launched, they might say, well, there's absolutely nothing to see, it's too early for me. But often some kind of capped test launch can be a good idea, so that you can show something, but you're not disappointing them with the fact that, you know, it's not, you know, up to whatever it is, £1 million a year revenue, or you just can find yourself caught between these two places, which is a subtlety, but it's worth being strategic about when you raise in relation to when you've launched.
No, that is really interesting, because this reminds me of the time when I was in the pharma industry and we were working a lot with biotechs. And in the biotech industry, you're much more valuable before launch than after launch, because after launch, you become a multiple. And before launch, you are a multiple of a dream. So, you know, to what
it's exactly the same. It's exactly the same. And I think it's stuff like that that's really putting yourself in the entrepreneur's shoes. It's not a particularly investor-y perspective, but I think it's useful because it does happen, and it can be frustrating for founders.
Yeah, and I think the other frustrating thing for some of our early startups is that they feel like, if I had the funding, I will be able to show you the traction. But because I can't show you the traction, I'm not going to get the funding. So it becomes a kind of a vicious circle for some of them. And, you know, I'll love to ask you about that after this, after we hear from Louis, what he thinks about the kind of metrics he looks for. I know you're a little bit later stage, but still that's really interesting, because some of our startups are scaling.
Yeah, I think what's interesting here for our audience is to understand that VC investors and VC funds are in the business of like making big exits. So this is the first reason why we're looking at numbers and trying to understand if those companies can get big. So I would pick up like three data points, three type of numbers. The first one is, of course, revenue growth, because you want to show to your investor that like you're able to scale fast and deliver and build a big business. Because like, yeah, it's cool to build a brand of, or like a software company of a couple of millions, but we know that to make a good IPO, or like to be sold for like a big number, so meaning more than 100 million in exit value, you have to show traction, you have to show revenue, you have to show a certain size and some customer engagement. So the second data point, of course, is what Katie mentioned about CAC LTV, and following the same train of thoughts. It's about the ability to show that your product or your solution or your service is sticky. So we looked at cohorts, retention numbers, and trying to understand customer behaviors. And this has to be linked also with customer analysis, sentiment analysis, and customer reviews to understand customer love. Do your customer love the product? Do they only like it? Is it really sticky? Is it there to stay? So this is very important, because a lot of companies can deliver like strong growth for 1 year, maybe 2 years, maybe even 3 years. But can they build like a big success for a solid 5 or 10 years? This is the question. And the last point is about the margin structure. So we tend to invest in companies that have optimized margin structures, because like for food brands, so meaning a lot of our portfolio companies, the corporates pay a lot of attention to profitability. And the question is always, do they have to consolidate losses? So being not far from break even is always a question, and having like a sustainable business model is key. So we have this methodology of looking at this structure called CM1, CM2, CM3. So CM1 is gross margin, CM2 is gross margin after delivery and payment, and CM3 is all of this after marketing cost. And we want to invest in a healthy business model. And then I would conclude by saying that for the rest, I couldn't agree more with Dominique and Katie. It's the typical TTM, traction team markets. So we want to make sure that the market opportunity is there, and that the traction is, of course, there, as we already discussed it, but that the team is amazing. We want to back the best entrepreneurs out there.
Thanks, Louis, for yet another acronym that we can put into our diaries. TTM. That's a new one to me, but I'm sure it's commonly used in in your marketplace. In fact, we've got a question in the chat box, which was the question that I was going to come to right now. So, we've talked a lot about food and food tech. How do you feel about pet tech? Is there? I've seen some big investments in Tractive, for example, in some marketplaces. In telemedicine, I've seen that. So how do you guys feel about, generally the pet tech market? Katie?
As I said, we're excited about it. I think people,
You've done influence, right?
There's a humanization of pets. I remember when we did the Many Pets investment, I spoke to the CEO of Pets at Home, and I remember him saying, and I said, what do you think the demographic of this will be? And he said, at Pets at Home, we have the mentality of, it doesn't matter how rich or poor people are. What matters is, do they say goodnight to their dog before bed? And do they sign their Christmas cards from their dog? And if they do, they're a potential customer. And I think that's what's so interesting about pets. It's like, people love their pets. They're willing to spend on their pets. Their pets are part of the family. And in that context, there's a lot less stuff for pets still than there are for your children. So I think, we're still right at the early stages of vitamins for pets. Pet nutrition is still really in its infancy versus, human nutrition in terms of specific diets, truly tailored diets, truly clean food, potentially meatless meat for pets. There's all that side of things. And then within that, there's all the different types of pets. Obviously, dogs is often the category everyone talks about, but cats are also very underserved. And then there's all the other pets, the periphery pets. So I think, and equally in healthcare, there's a whole universe of human healthcare that's potentially ahead of us, and in the same way, there's a whole universe of pet healthcare that's potentially ahead of us. So I think the world's your oyster. Like, at the end of the day, they're animals. Humans are animals. What's nice with pets is that it's the humans buying for the animals as well. So you've got the mentality of a human, but you've got the white space of the pet need. So yeah, I know that's a kind of general answer, but I think there's loads of stuff that could be the future of pet tech.
And what about you, Dominic? I see you grinning. I think you've got lots of ideas.
Now
that you've seen so many pet techs out there.
Yeah, absolutely. I mean, I got exposed to the pet sector for the last 2 years, and this is kind of humanization, as you mentioned, Kathy. I see what is happening in the human world, and pet is just coming after it. You look at the human industry, and you look into direct to consumer, you look into healthy food, etc., etc. But it's just basically happening also at the pet sector. And very often in the target group, you're talking about, yes, family with kids. But if you see how many pets are around there, as many as kids are around, and you have exactly the same structure as the influencer, which is the pet, and the decision maker, which is the owner, basically. So it's super exciting space, and there's a lot of blank spots there.
Louis, you have done pet food, but then would you ever think about pet tech?
Yeah, I think pet tech is very interesting, but like more generally speaking about pet food, we love it. Of course, we invested 3 times in pet food companies. I think what we like about pet tech and pet food more specifically, it's that it's a very recurring business, because like the dogs have very predictable consumption behaviors. So this is really interesting, but this is more for the food part. For the tech part, there's a lot of innovation happening. So we see a lot about the 360-degree care approach, which is powerful. So you can think of snacking, you can think of, so I mentioned the televet services with Barkin. You can also think of insurance products for dogs, because as Kate mentioned, like pet parents, like not really
20 minutes, je pense.
Not really think in terms of like actually like their dogs are their new kids, so like they do care about their health, and You can see this in food, but also like in terms of insurance. But from an investor perspective, it's super interesting because like most of those models use like a monthly subscription, so it's super predictable. You have recurring revenue, so it's easy to value. So definitely interesting. And the last point from an investor perspective is that the large corporates, so for example, Purina, Nestle, like are definitely keen to acquire those companies and to rotate their portfolio. So so a lot happening in this space, and it's really like eating up.
So I think pet genetics are interesting, as in we have the ability to do a lot more with pet genetics than we do, and I'm sure that that data, especially as the cost of doing it comes down, I'm sure it will feed more and more into various elements of pets in terms of breeding, in terms of nutrition. So I think that's an interesting kind of space to watch, as well as, you know, obviously pet care, like doggy daycare, all of that kind of thing. You can actually get some amazingly profitable businesses in that space, and there's a lot that still could be done there as an industry, I think.
Yeah,
pet aesthetics.
Yeah, you're right. And I think Europe is kind of lagging slightly behind the US. I see a lot of these investors are coming from the US, you know, trusted house sitters, which is kind of how dog sitting and you know, in that space. You know, rover dog walking, we see telemedicine, we've talked about services. I think, you know, in Europe, we still need to encourage investors to take a closer look at them. Embark from the US is in genetics. They've raised a lot of money. I think the European companies are actually finding it harder to raise money. So I think with you know, with what we're doing and raising the awareness of this, this will certainly help pet tech come this notch up in Europe as well.
We saw a really profitable business recently that was chicken coops. I mean, we didn't invest it in the end, but it was like, I can't even tell you how profitable it was or how fast it was growing. It was incredible. And all they did was chicken coops, but it was specific for chickens instead of like just buying a random cage. It was like really done with love. It was brilliant.
That's really interesting, the kind of things that you see. I've got some questions here. There's a question on your view. So do you invest in startups that are potential bolt-on acquisition targets for larger players? And it's very precise here with a valuation of 10 to 50 million within 2 to 5 years. What your thoughts are on that? I guess that's a question that's in Dan's mind. Maybe that's for Louis.
Okay, so I think yeah, it's pretty this one is pretty obvious, of course. Like again, like I think we discussed it, but like for an angel, or for that's even more true, like for VC funds, we're in the business of selling companies. So we invest at X, and ideally we want to sell this company at 5, 6, 7, even 10x. So so more broadly speaking, I think what we need to understand is the exit path and the ability to deliver a good exit. So, for example, pet tech and pet food are more like there is innovation happening, but there are already like example of success. So if we think of Tails.com, for example, so here the mission is to understand the reason why it's been a success, and like the drivers of acquisition, and whether it's possible to replicate this kind of story. So so this is the first case. The second case is more like, okay, it's an emerging market and there is no track record in this space. So then you have to believe in something. And this something can be the team, of course, but this can be also the early traction. And so we are back to the points we discussed before about the numbers, the retention, the stickiness of the product, the engagement of the community. So yeah, and maybe one last point about valuation range. I think we tend to be quite conservative in terms of valuation for one reason, which is that the acquirers can be quite rational. So you can't like overpay the deal, otherwise you're screwed for obvious reasons. So yeah, but there is a price for everything, and then there is competitive tension for some deals, and like always, like the price can go up. So then it can become a bargain. But I think that generally speaking, we tend to be quite rational and data driven, and offer a valuation that makes sense based on multiples and similar transactions.
Good. There's another question about runways.
Sorry, I have something to say
sorry,
on that
go
point.
ahead. Yes.
I think, so we internally, for example, we're looking for things that can exit for at least 250 million plus. The reality is, Tails is a great example. Tails was a brilliant exit. We made an amazing return. It was fab. It was a sub 250 million exit. That's not to say it couldn't have been bigger, but do we consider that a success? Yes. Do I think it could have been bigger? Yes. Is that what we're looking for when we go in as an exit? No. And I think it's worth understanding that, because if you are projecting a kind of 50 million exit value, you will get a lot of no's from funds. And often the reason for that, like, I was talking to a fund recently and they've got a £3 billion fund. They are looking for each investment to be a fund returner, which means that any investment they make, they have to believe internally it could be worth at least 3 billion. You do get variations of that. There's some funds that are looking for, a third of the fund to be returned, but it's that kind of mentality, like, I'd say like very few are looking for less than a fifth of the fund to be returned. So that kind of puts pressure on stake sizes and exit valuations. So it's not to say that you can't have a successful business or have a great return or a great investment from a smaller exit point, but most funds especially will be looking for, we're on the small side in terms of return expectations. Most are looking for at least 500 million, if not 1 billion exits as a potential for each when they're going in. And if they don't believe you could, in theory, get to that, they may well not do it. So it's worth being aware of that as a mentality. Angels can be a great route to kind of circumvent that, but it's worth noting.
Good. Dominic, anything to add there?
Well, I mean, from the multitude of startups you're investing, I don't know, the majority, or I don't know, 70-80% they go bust, especially early stage. So with the remaining 20-30%, you try at least to get back whatever you invested with a nice multiple. That's basically how I'm looking at the things. Really, at the end, it's a business. You have to invest in something you love, you're passionate about. So, of course, the fun factor is some kind of return, but it doesn't pay your bills. So it is really, some go bust, and the other ones, they have just to pay for it with a nice multiple. And if there's a multiple of 5 times, 5x, 6x, it's fine with me.
Yeah, that makes sense. There's a question about runways. I'm not sure if that's really true. Do you guys look for long runways? Is it important to you? I'm not entirely sure if it's true. Is it important to you, Kathy, that a startup that you invest in should have a long runway?
I think you need to have at least an 18-month runway in terms of, you need to be able, fundraising is very time consuming. You don't want to be doing it more, if you can help it, more often than like once a year, absolute max. And then it's going to take 6 months to raise. So if you've got 18 months in an extreme situation, then you can start fundraising after 6 months and then close it after 12 months. And then if you can't, you've got a 6-month buffer. So I think, I'm not looking for a long runway, but I'm not looking for you to close the round and start fundraising again, because you want to be running the business.
Yeah, you want to be working. And Louis, how long is long for you?
Yeah, I think I would have like a different answer here. I would say that runway can't be a standalone metric. We could be fine with a 12-month runway, but then the question is how much revenue and how much traction you're going to deliver in this period of time. So we tend to be super aggressive and to aim at the big numbers. So if you're able to show a credible path towards like tripling or ×4 or even ×5 in 12 months and being able to raise another big round of funding, we're fine with it. And it's pretty much a journey that we had with all of our portfolio companies. If you think of AirUp, if you think of Buttonbox, for example, they've raised like several rounds from great investors like Al Caterton. So yeah, I think below 12 months is too tight. But like a solid 12 and up to 18 is a good number, and above 18 You might wonder whether it's a VC case, because you might thinking, well, those guys might aim for yeah, smaller numbers and slower growth. So it has to be explosive and credible. So 12 and up to 18, I think it's a good range.
Yeah, I think 12's the optimum, but I think you have to be able to make it last for 18, ideally, for your own peace of mind, if you have to.
Yeah, absolutely. And for the startups, they should just never underestimate the time it takes to fundraise, really. Because if you see the wall in front of you, you start really being desperate and doing silly things. And if you invest into a company, and the runway is too short, you don't want to be the sugar daddy and keep on investing. I mean, that's I've done this once. I'm not doing it for the second time. I believed in it. And I thought it would be easier to get another one. And then it's basically, if I don't pay, they go bust.
And if I can add, if I can add on this, I think here for us, we are able to bridge our companies and to use some tools like convertible loans, and to set a future target for the next rounds of funding, because we understand that building a company can take time. So sometimes founders do deliver and do good things, but it just takes more time. So we are able to buy this time by bridging them. But again, I agree with Dominique. Sometimes it's more like a defensive scenario, and you have no other choice than like bridging them, which is a different setup. But going back to the runway point, I think we as an institutional fund, we are able to extend this runway if things go well. So it should be, of course, a big part of the discussion when analyzing the business plan, but we should not be too fixed on one number in terms of runway.
Yeah, and I think this really gets me to the point. I'm just thinking that it's so important for startups to know their investors, right? I mean, many times startups do a machine gun approach. They try to target every investor they have with the same deck, with the same story, and it's really important that you know your investors when you talk to them. It's really targeting your audience. I've got a Jackie here who runs a pet genetic company. I'm going to connect Jackie with you, Kathy. I think you may have something to talk about. I think she's quite excited by what you've said. And another question here that is coming from Jean is about business models based on subscriptions. I think that's an interesting one because, in the news, we have seen how Netflix seems to have, I don't know whether they're struggling or whether they're just coming to a plateau. So there's been some questions about subscription models and whether they can continue winning. All of us, we do not want to have 20 subscriptions, and everybody's trying to get us to subscribe to a pet supplement, to a pet food, to a fresh, to a fresh basket that I get for my home. So how many subscriptions can each of us have? And what do you guys think about the direct to consumer subscription model? Are they going to win in the future, or do we have to be careful about that? Anybody wants to take it?
I can take this one. I think subscription for people are different than subscription for pets. So it's two different personas. So of course, if you have a subscription for your dog, receiving your food every month or every week or whatever is different than what you do for example, Netflix or whatever. So of course, there's a question of total basket and your purchasing power. But I think the studies show that people and consumer are quite keen to spend for dog because there is this premiumization trend, but also this humanization trend. So, and they tend to decorrelate what they spend for themselves and for their dogs, actually, or pets.
Dominic, what about subscriptions for you? Do you think they're going to win forever?
I think it's different if it is a subscription for a service or for a product. I mean, having been delivered, I don't know, once a week or every once a month a package. I think it's different because maybe you don't want it anymore, or there's some strings attached, you cannot get out, or you're not there, etc. If it is a service, if it is for an app, or something else, I think it could be really working. Yes, and if you find a subscription model, it's a gold nugget. I mean, it's a recurring business with a high retention that is just coming in. Yes.
Good.
I think the hurdle's just higher for a consumer when you're asking them to subscribe to something. So it's better as a business if you can get them to subscribe, because you've got this kind of more guaranteed repeatable revenue, but it's harder to get them to subscribe. So I think you just have to be clear as a business what your USP is, why they're going to subscribe to you. Can they just add it onto their Ricardo order? Can they just get it from Amazon as a one-off? Like, if you've got a clear proposition and a clear reason, like Tails.com is a great subscription business. It's a reliable, regular need. And like Louis said, it's in a different camp to the kind of human subscription. So I just think it's a purchase occasion like any other purchase occasion, but there's a higher hurdle because you as the consumer are committing to more than a one-off purchase. You're committing to having to make the effort to cancel it, and if not, a kind of recurring cost.
So I would like to ask you a question about what goes on in your mind when you're listening to a startup pitch to you, whether you're reading a pitch deck or you're talking to somebody in person, or perhaps at a demo day, right? We've got lots of demo days, one after another, 5 minutes each. How do you handle all that information coming to you? And you know what's going on in your minds as you are listening to all that? Katie, you want to start?
The truthful answer is the most common thing that's going on in my mind is, what is it? Because you wouldn't believe the amount of people that just because they know that area so well, they just launch into, you know, this is the opportunity and this is the traction. And like, I think it's true in pitch decks as well. Just a really simple explanation in a sentence of what you're doing is really helpful. So that's the most common thing that's going on in my mind. And then once I've got over that, it depends on the context. I think a demo day is a really specific situation that I think it's worth talking about in its own right, because a demo day is kind of an artificial environment. It's a bit like Pop Idol. It's like you're seeing one after the other pitch in a very short space of time. You know, it's just kind of it's an unusual environment, and I think it's a different occasion than a one-to-one pitch. So what's going on in a kind of demo environment is what stands out here. So, you know, it kind of tends towards spikier things that stand out because you're just seeing them like back to back. In a pitch environment, you probably more focused on the kind of specifics of that company. So the essence, as I think Louis said before, is you're ultimately, you know, is this a business I'm excited about? Can I see it having a great exit value versus the valuation that it is now? Like, can I believe in this? Is probably what you're thinking as you get into the nuts and bolts.
So it's important to say what you're doing instead of starting with a pitch that says, I'm going to save the world and this is the market, and it kind of is a little bit vague, and you know, you feel like you're
we are this is like really good.
Fantastic. And what about you, Louis?
No, I think Katie made a very good point. Simplicity is a key value. Being able to explain what you do in simple terms is king. Let's face it. Now, if I talk more about the people, I think I look at three things. The first thing is the level of ambition of the founder. Is she or he able to build a big business, a 200 million revenue business, and sell it for the same price or something even bigger? And you can feel it. You can feel this level of ambition if the person is like an hustler and is looking for the big numbers. The second thing is the ability to pitch. Is he good at delivering a message, delivering a vision? And this is key because typically we're maybe a bit more later stage than Katie and Dominique in what we do. But in most cases, there would be other investment funds that would invest in our companies and back them in the future. So you need to make sure that the founders are strong enough to raise follow-on rounds. and like to deliver this strong vision to other investors. And the last thing, which is also very important, is the ability to listen. Because most of the time, founders are very good at pitching you. They are very proactive. They know how to handle requests, etc. But are they good listeners? Can they work with you? Can you work together? Because you have to think long term. It's like, again, going back to the marriage comparison, you have to make sure that you're able to build this 5-10 years relationship, and that this relationship is going to be healthy. So thinking long term and being able to understand each other and the fit behind the pitch is very important.
And what's in your mind, Dominic, when you listen to somebody pitch?
First I listen. I look at the person. I want to feel the energy of the person. I would like to see is the vision and the energy of the person contagious. What is the driver? Is it just being rich one day? That's for me wrong. Is it somebody that really tries to solve a problem? And then, is there really a problem? Sometimes you hear things that, well, I don't think this is a problem. Why do you want to solve something where there's not even a problem? And then what you said, Katie, is sometimes they talk about the product and the service, and it takes me 5 minutes to understand what is he talking about. Because I just don't get it. Really, I still don't get it, even sometimes after 15 minutes. And then when you start getting into arguing, that's when it stops for me, when they really try to tell you why you don't believe in it. So, but it's really at the very beginning, the driver is the founder, it's the person, it's the vision behind. Because if the energy, the vision of the person is contagious towards an investor, it's also to employees, to customers. You have to feel this. And this is super important, especially at the beginning when it's all about storytelling and selling dreams before selling the first product at all.
So we have 3 minutes left. There are some questions which we won't be able to answer, but guys, if you put it into the Slack channel, we will try to answer those questions for you. The last minute from each of you, could you give us some tips for startups that are preparing for fundraising? So a minute of tips. I know, Katie, you guys were a startup before, and you said that one of the big things was that you were given a break, and therefore, you were able to exit to Coca-Cola innocent drinks. So maybe a tip there, maybe some tips for our startups.
I think have a plan. Sounds obvious, but that plan may or may not be shared with investors. It depends on how much detail they like to go into. But I think really knowing what your plan is, and I think Oscar Wilde once said, it takes me longer to write I don't have time to write a short letter, so I'm going to write a long one. I think being able to distill that plan, like I remember when we invested in Deliveroo, which we did pre-Series A, so it was super early, and he had a model that was on 2 tabs. And the first tab of the model was under 10 KPIs I think it was more like 5 KPIs that he knew that those were the key things to measure in that business. So like the most crucial of all was driver time, driver throughput. So how many orders per hour was a driver going to do? And it was just, he'd really taken the time to understand his business and the key drivers of that business and how he forecasted that to change over time. And I think that's the most important thing, having a plan that you really understand before you go into fundraising. The other thing I'd say is, if you're new to all of this, I'd start with some pitches, like with interviews that you don't really care about, to kind of, because everyone has good days and bad days. And I think just getting used to your own patter and like the kind of questions that are asked and, nerves, etc. I think that's a good strategy. And as much as possible, and I say this, having come out of a fundraise recently ourselves, where we raised our own fund, which was a great lesson in kind of empathy. But I think having focus on getting the keystone investors, so like the big anchor investor of the round, and then have quite a strict timeline, like we are going to close at this date and then do it. So you need to create a bit of FOMO. Like the worst thing you can do is kind of go to 100 investors and say to every one of them, we're looking for a lead, we've been doing this for weeks, and like let them drag you into asking for more and more data as much as possible. Focus on where you can get the big checks, close those big checks, put a deadline. We're going to close in a month. Are you in or you out? Create FOMO, like we're oversubscribed, da, da, da. Like there's a talent to fundraising, like there's a talent to everything else. So I think being strategic about how you put the round together is useful. Thank you. Louis?
Yeah, I think a couple of pieces of advice. Like the first one is the network. We always say this, but network. It's a business of people, so you have to meet the people that could help you, like in the next few months or in the next few years. So be in touch with the people. Those people is very important, and you never know what could happen from one single relationship or intro. So yeah, the network is key. The second thing is, in terms of pitching, is get your pitch deck challenged by your peers. So it can be, if you know some investors, it's good like to do some practice session or just ask for like a view about your pitch deck, or like practice with other entrepreneurs. So if you're part of an incubator or accelerator, or yeah, like I think it's very important to have different eyes on your pitch deck. And the last piece of advice is really like practice. It seems obvious, but you see a lot of entrepreneurs that come unprepared. They don't know what to say. They don't have a plan, as Katie said. So like practice makes perfect. You need to have a plan. You need to have everything clean and neat. So if you want to build a data room for your investors so that they have all the information available, and it gives this sense of professionalism. So it's very important to practice and have a proper set of material that you can share with your investors.
Great. Dominic, last words? What are your tips?
It's super important that you really know your business and you know exactly what you want. A pitch is not a brainstorm session. If you must know exactly how much you're looking for. And if you've been asked, okay, so you're looking for 2 million, what are you doing with this 2 million and where will you be after this 2 million? And yes, I will do some sales and marketing. Okay, I mean, no, you know exactly where you want to go. So you have to perspire confidence. I mean, that's one thing. Second one is be consistent. Investors, they do know each other. They even share pitch decks. I have seen different pitch decks, which I think it's just crazy. You should have exactly the same plan. You have one story, one plan. That's one thing. And maybe the last one is, even though for you it might be the 50th pitch you're doing as an entrepreneur, for the investor it's the first time he hears it. So really full of energy. Don't give up, just push for it. Also, if you spoke the same thing like a broken record, you said it already 20 times, just go for the kill.
And make sure it's believable, right? Thank you. It's been very exciting. Thank you so much for spending that hour with us. It's been very useful to me, I'm sure to our community as well. And I wish you a very good afternoon and lots of pitch decks to read and to invest in.
Thank you.
Thanks, Kim. It was a pleasure.
Thanks, guys. Thank you
for
very much.
inviting us.
Thanks, everybody, for participating. Thank you very much.
Bye.
Bye.